Purchase orders are those very common documents that impacts many different departments among an organization, from the purchasing professionals who create them to the sales department who receives them and sees to the fulfillment of the order, to the billing department who creates the invoice associated with the purchase order, and finally to the accounts payable team who uses that purchase order as part of their invoice verification process. More on that later. Let's take an in-depth look at how purchase orders work and what can and frequently does go wrong when they're not used correctly. We'll also investigate blanket purchase orders and the problems associated with this very popular approach. Let's start with a look at what exactly a purchase order is.
A purchase order. A purchase order is a legally binding document created by a buyer and presented to a seller. Purchasing and accounting professionals frequently refer to purchase orders using the shorthand abbreviation PO. Each PO or purchase order should have a unique number associated with it, and this is frequently referred to as the PO number. Do you know the difference between a purchase order and, of course, the corresponding purchase order number, and an invoice and the corresponding invoice number, and what each is used for? Purchase order numbers and invoice numbers are two numbers used for several different functions in the procure to pay and accounts payable space, and they are very different. These critical determinants are key to an effective and efficient processing of an invoice. Purchase orders without PO numbers, as we sometimes call them, and invoices without invoice numbers are not acceptable in even a basic accounts payable function or an accounting function. You need both. Let's get started with the purchase order, since that is the document that is created first and ultimately triggers the invoice. A company, the customer, creates a purchase order to basically place the order. It should contain all the information the supplier needs to fill the order. So it will indicate what is being ordered, how many, what the price is, and any other terms and conditions. Once it is accepted, the supplier fulfills the order, ships the goods, and then creates an invoice to bill the customer and hopefully get paid. This is where the purchase order number and the invoice number come into play. In most organizations of any size, the company will have many orders. The way they differentiate one from the next is the purchase order number, which is frequently referred to as PO number. This identifier helps them locate the order and the details related to that order, as well as identify who placed the order if there's a problem or for other reasons. Hence, it is critical that when a supplier creates an invoice to bill the customer for goods sent, they include that purchase order number on the invoice. This helps the accounts payable person identify who they should go to get the invoice approved for payment. And let's face it, if you're creating and sending invoices, you want to get paid as quickly as possible. Thus, it behooves every supplier to include the purchase order number on every single invoice they prepare. While this may seem pretty obvious, you'd be surprised just how many invoices are sent without a PO number on them. Invoices, on the other hand, are a fancy way of saying bills. Although, to be fair, invoices often have a lot more information on them than the bills you and I receive. In an ideal world, one, by the way, which none of us lives, the information on the invoice would match exactly with the invoice on the purchase order. The invoice contains the detailed information about what was ordered and shipped and shows the amount of money suppliers expect to receive from the customer. Now, perhaps you've heard of something called the PO flip. This is where the supplier takes the purchase order and flips it and creates the invoice from that. That again assumes that everything goes perfectly, and we don't see that happening that frequently. So we will have to deal with the possibility, the very likely possibility, that some of our invoices are not going to match the purchase order. Although neither the invoice number or the purchase order number are used directly in that all-important three-way match done to make sure payments are correct, they are critical in seeing that the right documents are identified and used for that purpose. The invoice is so important when it comes to efficient and effective processing of an invoice that many ERP systems will not accept an invoice with an invoice number that has already been used, obviously an invoice from the same supplier. This is one of the many reasons that some organizations do not permit partial payments against a purchase order. While this may seem to be the silver bullet, if you will, when it comes to avoiding paying invoices twice, it has not turned out that way. For starters, for it to work 100% of the time, processors would have to key in the invoice number correctly, and that doesn't always happen. Let's face it, they are more concerned about getting the dollar amount right and the PO number right. And I would be as well if I was processing invoices. Also, and I'm loath to share this with you today, but it's the reality of the world we live in, more than a few invoice processors at organizations where ERPs will not accept a duplicate invoice number have figured out a way around it. They know by adding a dot, a space, a letter to the end of the invoice number, they can force it through, which of course is not what you want them to do. The other reason that invoice numbers don't offer the total protection against duplicate payments that you might hope is that occasionally suppliers will change the invoice number when they send a second invoice. As you might imagine, this raises all sorts of additional headaches.
Now, let's turn our attention to how purchase orders work.
How does a purchase order work? A purchase order should include all the details related to the order so there can be no confusion. This might include an item number or the name of the good and any other defining details such as color. It should also include the quantity, the payment terms, and any delivery details that might be needed. Once the purchase order is accepted, if it documents the transaction as agreed by the buyer and the seller. What are the 4 kinds of purchase orders? There are a number of different kinds of purchase orders, and we're going to take a look at them all. Purchase order type number 1 is referred to as the standard purchase order. This is the one that we are most familiar with, the standard purchase order, and typically it is a one-off and is for a one-time purchase. Even organizations that do a lot of businesses together will use standard purchase orders, although they will have negotiated standard terms ahead of time, and these will automatically be included on the purchase orders. They don't have to reinvent the wheel every time they get started. Purchase order type number 2. It's called a contract purchase order. And these are agreements used to create ongoing commercial relationships between a buyer and a seller. They spell out the terms and conditions, include things like payment terms, delivery terms, who pays for the freight, etc. However, and this is the big difference, no products or orders are specified at that. Purchase order type number 3 are called standing purchase orders. And these are used when the same amount of an item is ordered repeatedly at a given interval, say weekly or monthly. So an example might be a coffee shop who orders 100 pounds of coffee beans each week, and every week that order just repeats, okay? So it's a standing purchase order. And in this case, the same purchase order number is used for each of these purchases. And it goes without saying, if you're working in accounts payable and you're dealing with this, you need to be very careful that you don't end up paying for something twice. Okay, and our 4th type of purchase order is called a blanket purchase order.
You may also hear blanket purchase orders referred to as standing purchase orders. You'll see it abbreviated as BPO. It is an agreement made between a buyer and a seller, or a supplier and a customer, where the buyer provides the seller with a standing order to provide goods or services on a recurring basis for a certain period of time. The terms and conditions, including pricing, are spelled out. Sounds simple, right? But here's where most organizations get tripped up, especially when that pricing isn't as locked in as they think. The components of a blanket purchase order are similar to those of a regular purchase order, with some variations. So let's go over them. Coverage. As you might have guessed by now, one blanket purchase order covers multiple invoices. Typically, with a regular purchase order, it only covers one invoice, although some, but definitely not all, will allow multiple invoices in the cases of partial ship. Blanket purchase order number. Similar to a standard purchase order, each one will have a number associated with it, making it easier for tracking purposes. It is generally tied to the requisition associated with it, and it is used in accounts payable for the 3-way match when the processor is verifying the accuracy of the submitted invoice. Life or duration. This is one of the areas that is very different from a standard PO. Blanket purchase orders are commonly issued for a set period of time, frequently 1 year, and they can be extended based on an agreement between the buyer and the supplier. Pricing. The prices of the goods or services are usually fixed in the blanket PO. We'll address this issue in further detail later on when we talk about that court case. Ordering. Under a blanket purchase order, orders can be placed as frequently or as infrequently as needed until the contract expires or the maximum order limit on the blanket purchase order is reached, whichever comes first. Timing and amounts. Blanket purchase orders offer flexibility in terms of quantities and delivery schedules. The exact quantity and delivery dates don't have to be specified upfront, but rather as needed. Oftentimes, the quantity isn't indicated, and the blanket purchase order says something like, as needed. As you will see later on, this could create a huge problem, especially if prices skyrocket. Cancellation policy. This outlines the terms and conditions under which an order can be canceled. The policy may vary widely based on the agreement between the buyer and seller, but typically includes a notice period, a cancellation fee amount, the conditions for the cancellation, and the process for the cancellation. There may be a limit on the time frame that allows an order to be canceled. Some of the reasons companies like purchase orders are probably pretty obvious now, but let's quickly go over them because they are not all that obvious. So why do folks use blanket purchase orders? The most obvious reason is it streamlines the procurement process for repetitive purchases, making the process more efficient. Instead of issuing individual purchase orders each time a product or service is needed, a blanket purchase order allows for multiple deliveries of the same product over a specific period of time under the same blanket purchase order. Price stability is often stated as a reason, as price volatility can be a major concern in procurement. With a blanket purchase order, the price of the goods or services is typically fixed for the duration of the long-term contract. This means, in theory, that even if the market prices fluctuate, the cost to the buyer remains stable. We'll investigate this later on because it appears this is not always the case, despite what the issuer of the blanket purchase order believes. Typically, blanket purchase orders offer a degree of flexibility, a high degree of flexibility that allows for adjustments in quantities and delivery schedules based on the buyer's needs. The exact quantities and delivery dates don't have to be specified up front, which can be extremely useful when dealing with an unpredictable demand or changing business conditions. By committing to a long-term agreement, blanket purchase orders can help strengthen the relationship between the buyer and the seller, can lead to improved communication, better understanding of each other's needs and expectations, and potentially better service or unit pricing terms. Also, by consolidating orders with one supplier and committing to a much larger total volume of purchases over time, you should be able to negotiate better prices, which will lead to cost saving. But all that glitters isn't cost-effective gold. Let's talk about some of the drawbacks. While having a long-term agreement with a supplier can have its advantages, it can also create a certain level of dependence on that supplier. If the supplier experiences issues such as financial instability, production problems, or quality issues, it can impact significantly on the customer's business. If the supplier goes bankrupt or out of business, this can mean a strategic nightmare for that customer who has been depending on them. That's why, no matter how much an organization likes one supplier, they're usually advised to have more than one supplier for all key components. There's another issue with blanket purchase orders that is frequently ignored. Locking into a blanket purchase order with a single supplier may result in missing out on competitive pricing from other suppliers. Market prices can fluctuate, better deals can become available. But if the purchaser has committed to an agreed upon price for an agreed upon amount over the duration of the contract, and this contract requires certain levels of purchases, they may not be able to take advantage of the better pricing being offered by the competitor. This is an example of when a blanket purchase order can be viewed as a double-edged sword. So this brings us to the issue of just when should you use blanket purchase orders. The most common example is for ordering office supplies, assuming the organization uses a great deal of them. The quantities of the goods or services are needed throughout a period of time and therefore are reordered regularly. Also, they make sense under any of the following conditions. If a single vendor is capable of delivering throughout the length of the contract. This is why some will do a credit review of the supplier before issuing that blanket purchase order. If the unit cost can be well defined and the details specified, or if ordering in quantity facilitates more favorable contract terms and quantity discounts. Alrighty, now let's talk problems, because this is where even the seasoned pros get burned. Once you've decided to go the blanket purchase order route, you'll probably want to avoid some of the common problems. So let's take a look at common problem number one: assigning incorrect invoices to that blanket PO. It is more important than ever that the suppliers include purchase order numbers on their invoices. That way, your processors don't have to guess which purchase order to assign an invoice to. And when they're guessing, those blanket POs are very convenient. They can solve a lot of problems, not the way you'd like. But common problem number two: not recognizing a second copy of an invoice and paying it after assigning it to a blanket PO. As blanket POs are utilized for multiple purchases throughout a given period of time, organizations run the risk of receiving multiple invoice copies for the same goods shipped or the services performed. This problem has exploded in recent years, as now 25% of all invoices that are sent are copies of previously sent invoices. Extra care must be taken to ensure that these don't inadvertently get paid because they're just blindly assigned to the blanket purchase order. Oftentimes, the purchase order controls will not prevent these invoices from being paid twice when they have that valid PO number and its reference. It is essential invoices reflect exactly what the PO calls for, and extra care needs to be taken to ensure that the same invoice number has not been previously entered and that your processes are not changing invoice numbers slightly to push them through when they don't realize that it's a second copy of a previously paid.
So what is that purchase order mistake that costs millions? After a payment is made, regardless of whether you pay with a check, a card, a wire transfer, an ACH, that purchase order should be extinguished or closed out immediately. I can't say this loud enough. Immediately. It's that simple. Don't wait for the end of the week or the end of the month, and then you can do them all at once because it might make it a little easier for you. Do it immediately. I can't stress this enough. Why am I making such a big deal about this? Why is this so critical? Because if you don't close it out immediately and a second invoice shows up, and this has become a huge problem today in most accounts payable departments, there is a decent chance that when that second invoice shows up and the purchase order is still outstanding, it will get paid. And as many of you listening to this know, suppliers rarely return that second payment unless you find it and ask for that money back. And that's more resources required on your part to track it down and figure it out.
As we've already discussed, purchase orders have a number associated with them. This is of critical importance to the accounts payable team processing an invoice related to a purchase order. Regrettably, more than a few companies forget to put that purchase order number on the invoice when preparing those invoices. Let's see what happens then and look at the recommended best practices for handling such invoice.
Do you know how often, when purchasing forgets to reflect special deals on a purchase order, those special arrangements are lost? And sadly, many purchasing professionals do forget. The most commonly lost special is when special payment terms are offered. I think you'll be horrified to discover just how many of these special arrangements end up getting lost. The problem is exacerbated at year-end when many salespeople are trying to make their numbers, or even increase them, because bonuses are based frequently on sales. By now, you've probably figured out that when purchasing doesn't reflect special arrangements on the purchase order, the supplier is likely to follow suit. When this happens, there is no way for accounts payable to know of the arrangement, and the invoice will match the PO, and they will pay. Let me explain using a real-life example. Often towards the end of the fiscal year, which frequently coincides with the end of the calendar year, salespeople are trying to hit quotas so they can earn bonuses or bigger bonuses. So they push their customers to order more. But the customer, and that's you, doesn't need more product, so they don't order. Why should they pay for something in the current fiscal period that they won't use for months and months? For starters, it'll make their financials look worse. It would be like you stocking up on 6 months' worth of canned tomatoes and paying full price. You wouldn't do it. So in order to get the order and meet the targets and get those bonuses as large as possible, the salesperson has to sweeten the pot. Typically what they do is offer longer payment terms. So instead of paying in 60 days, they offer 90-day payment terms. It's a mini version of the furniture seller who says, buy now, but don't pay for 36 months. This way, the supplier gets the order, they can record the sale, and the customer doesn't have to pay until after they might have normally paid. Now you're thinking, won't this impact sales in the next fiscal period? And you're right. But they take the Scarlett O'Hara approach to that and figure they'll worry about it tomorrow. It's a win-win for everyone until the purchaser forgets to reflect the special terms on the purchase order and the supplier doesn't reflect the special payment terms on the invoice either. And so, as was mentioned earlier, when the invoice shows up, the accounts payable team pays it because the three-way match worked. It is critical that everyone understands you cannot rely on the supplier to remember to adjust their invoices. As those who work in accounts payable are painfully aware, invoices often contain errors, and this is potentially just one more. Now here's the startling part, and my real-life proof, if you will. One large, well-respected pharmaceutical company stumbled across this issue. When they went back and researched their activity, they discovered they had lost 100% of these special deals that had been negotiated with a number of different suppliers. It's important that you understand this wasn't only a one supplier issue, it was across the industry. They went back and they looked for several years and they discovered each December they took advantage of a number of different special payment terms offered by different suppliers, and none had been reflected on their purchase order, and consequently none were on the invoice. They end up paying for all this extra inventory using their standard payment terms, losing all those special deals negotiated by their purchasing staff. Is this problem unique to this one firm or to the pharmaceutical industry only? Sadly not. What's more, this is even more likely to happen in an age of electronic purchase orders, where it is so simple to click a box for standard payment terms and conditions. Do I think that anyone is trying to deceive their customers? For the most part, no. Yeah, there might be a few who are trying to play games, but for the most part, it's just human error and lack of attention to detail. All right, you say, I understand the problem. What can I do about it? I'm not going to insult your intelligence by suggesting that you just don't do it, you pay attention. You know that. But here are some other steps you can take to proactively address this issue. Step number 1. Simply raise awareness of this issue, especially if you know that your industry is one where you get offered these special payment terms every year. If purchasing responds that, don't worry, the supplier will reflect it on the invoice, you can point out that no, they cannot rely on that. That is not likely to happen. What's more, if they issue a purchase order with your standard payment terms on it, they are in effect agreeing to pay in the standard period, not the extended terms that they think they were getting. What's more, they're actually costing the company money, as the company has to shoulder the cost of carrying this inventory for this extended period of time because they paid for it using standard payment terms. Step number 2. Although this really isn't an accounts payable responsibility, if they happen to notice that an invoice comes through for an unusually large amount of inventory, and it doesn't seem to have a special price or special payment terms, they can ask before scheduling it for payment. But in reality, you cannot expect the accounts payable staff to catch this after the purchasing staff missed it and didn't include it on the purchase order to start with. If they do, they are extraordinary, and you should thank your lucky stars you have them. Step 3. The accounts payable manager or the controller might sit down with purchasing and try and create a list of possible suppliers who might offer special terms at the end of the fiscal period. They can then double check their invoices, but again, this is putting extra work on an already overworked group of people, expecting them to catch mistakes that others made. For failing to mark special terms on a purchase order is a mistake or a shortcoming in the purchasing staff.
We've mentioned verifying invoices in the three-way match several times. It's an important step used before paying an invoice. To ensure you fully understand what it is and how it works, click on the link that has appeared on your YouTube screen and is in the description. Good luck.